Hi, everybody. Lynette Zhang, Chief Market Analyst here at ITM Trading, a full-service physical precious metals brokerage house. Well, as you all know, probably, they raised the rates yesterday. The Federal Reserve, I should say, raised the interest rates, and they set out plans to shrink their $4.5 trillion balance sheet starting this year. Okay, so here's the headline. And the reason why that was given for raising it, the Federal Reserve lifted a key U.S. interest rate and laid out a plan to shrink its massive $4.5 trillion balance sheet starting this year, a pair of moves reflecting its view that an economic expansion now entering its ninth year no longer needs so much propping up. So that is what they are saying. And they also have said in the past that they are data dependent. So let's look at how the markets reacted to the choice that the Fed made with raising the rates. And you can see these are the 2-year, the 10-year, and the 30-year bonds. And you can see that as they were raising rates, well, the interest rates on the market declined. In addition, so did the dollar, because they know that they're going to have to generate more inflation. That will weaken the dollar. Stock market liked it because, again, that inflationary pressure means easy money policies, and gold also moved up after it got whacked last week in anticipation of this, in my opinion. So that's how the market reacted to it, and you could say that they didn't really believe what Janet Yellen was saying. That's a possibility. So let me show you the real impact of it, okay? So this is the monetary base or newly created money. These are the excess reserves of the banks. You can see that that started in 2008, okay? Now this is the cost to the banks to borrow from the Fed, and the blue line is what they actually get paid on holding those excess reserves. So this is free money. The difference between that red line and that blue line is just free money, and it's all taxpayer based. So that is really the impact of the Fed funds rate increase. The banks just make more free money. Now, here's the data that I know that they're looking at, because this is the Federal Reserve data. It's not mine. And this is the sticky CPI, right? Consumer Price Index. So the sticky one are priced on goods and services that are included in the CPI that change price relatively infrequently, because the sticky is thought to incorporate expectations about future inflation to a greater degree than prices that change on a more frequent basis. So what we heard about was this little box, which are retail sales. But in addition to that, which is bad enough, you have a lot of other consumer goods, and look what's happening there. Does it look like it's inflationary? That would be a no. Those are highly deflationary. In theory, you raise rates, or the central bank raises rates to slow down inflation. They're saying that's transitory. Well, I'd agree, but this is why you can see we're in the deflationary part of the trend. Now, this is also personal consumption expenditures. And you can see that they are at the lowest levels that they've been since 2009, in the midst of the crisis. So you tell me, does that look inflationary? Is that the reason why they're really raising the rates? Or perhaps they're on a mission to raise the rates so that they can lower them, which they've said, so that they can lower them in the next crisis. You can be the judge on that one, because that does not look inflationary to me at all. And now let's look at the balance sheet. Okay, this is the Federal Reserve balance sheet. This bottom part are U.S. Treasuries that they bought, and this big part here are the mortgage-backed security derivatives that they have on the balance sheet. Okay, so what they said that they're going to initially do is just not, the reason why you see this flattening out, I should show you this. The reason why you see it just being flat here is because at least in these two areas, they're not buying more, but any interest that they get or any principal that they get, they're reinvesting them. Okay, so we're going to look at that. Oops. Okay. This is the quantitative easing program where the Federal Reserve bought the treasuries. Okay, this is Operation Twist, where they substituted shorter maturities for the longer maturities. They only started doing this back in 2002. Make no mistake, this is a hyperinflationary pattern. But since they are being paid to hold those reserves, it has not gone out into the economy. So at some point, it likely will in one way or another, or as the central banks try and generate that inflation. I mean, does it look like they have control of this yet? In my opinion, no. But if they do not reinvest those dividends, we've got a problem. Because last year, 40% of the deficits were funded by the Federal Reserve buying treasuries with that runoff, because they're not presumably adding more. They're just reinvesting the dividends and any principal. So what's going to happen when they're no longer doing that? Who's going to fill the gap? Are they going to issue more debt to fill that funding gap? And will they be doing that at higher interest rates? Can you start to see the problem with it and why I say it can't happen? It's just talk to make you think that it could happen, but you're looking at the data, and so is Wall Street, and they know that this poses a big problem. And this is the schedule of those bonds that are maturing, that are presumably they are not going to reinvest this year. So how are they going to fill that gap? That's a big question. I have no idea. Now on the mortgage-backed securities, you can see that that too was a new thing first done in 2009, that they bought those mortgage-backed security derivatives. So now again, they're reinvesting, those are longer term, but they're reinvesting any principal and interest, so you can see how that has flattened out. Well, can they stop doing that? Considering the fact that since they got into this market, they've bought 24% of the total market. And in 2015 and 2016, they bought 30% of the new issuance. So what happens when they stop buying new ones? Can you see the problem? In my opinion, there is no way on God's green earth that they can reduce that balance sheet. And at the same time that Janet Yellen was saying how wonderful things are and why they have to raise the rates because the economy is heating up, well, you saw that their data doesn't support that. But she also said that should they need to, they would do additional quantitative easing. Well, frankly, you see how well all of that new money printing has done so far. So what is doing more of the same? Well, Freud said it's insanity, and I would have to agree. But the other piece of it is that is how the hyperinflation, one of the ways that the hyperinflation is going to come here, because what they're doing with all that new money printing, it's not working anyway. So doing more of it, at some point, they will lose control of the inflation, and there you have it. So that's it for today. I hope you got a lot out of this, and you can see that they can say anything they want, and they will, to keep you in the system that is clearly from this data breaking down, and from lots of other data. I've just shown you a couple of places. So I would think that it would be kind of important to give us a call at 888-696-4653. And if you like this, give us a thumbs up. Subscribe to our YouTube channel, follow us on Facebook, like us on Twitter, and really, you be safe out there. And give us a call. Don't forget, 888-696-4653. Bye-bye.